Hi, this is Lex, and welcome to the Fintech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Hi, everybody, and welcome to today's conversation. I am thrilled to have with us Padman Perumal, who is the CEO at Masttro, a really interesting fintech focused on digital wealth management, data aggregation, and investing more generally. I'm excited to open up those themes. Padman has also had a deep set of experiences across the large systemically important banks, in particular across technology transformation. So I'm very curious to touch on those topics and open them up as well. And with that, Padman, welcome to the conversation.
Thank you, Lex. Nice to be here with you.
My pleasure. Let's start with where all the money is, which is with the large banks. Can you tell us a little bit about how you found yourself at Credit Suisse, at JP Morgan, and how you found yourself in roles that touch transformation for these organizations?
So I started my career mostly in technology as a software engineer. And as I worked through Credit Suisse, ended up being a client of a technology consulting company that I owned. And I ended up becoming an employee of Credit Suisse, leading their technology division here in the US for the private bank. What we see and what I experienced in wealth management over the 15 or so years that I was there, whether it is Credit Suisse wealth management business or any wealth management organizations around the globe, there are two things that are extremely important for these for these wealth management institutions. One is they wanted to make sure that they provide their advisors and the people that serves the wealth owners a productive experience, making sure that they can do their job in an effective and an efficient way so that they can spend most of their time in serving the clients as opposed to finding ways to administrative tasks on how to serve the clients. And the second thing these banks and the institutions are focused on is really providing a consumer grade digital experience to their end clients. As you can probably imagine, wealth management is still left behind in that consumer grade digital experience. What you are able to accomplish as a consumer through your iPhone or Android or smartphone, that is still not where wealth management client experience is. So those two things are what is, I would say, have been the challenges that I faced or we tried to solve for as I worked with large institutions and executives.
Let me ask you a clarifying question here, because there are some words that I'm sure the audience is going to conflate. You were in these companies during a pretty important shift in the investment management industry, this shift from brokerage models to fee-based models. And so just as a foundational definitional start, can you talk about what is the difference between wealth management, private banking, brokerage, and maybe banking generally? And of course, through your journey, what's the cultural difference between being at a brokerage firm, helping brokers support their clients versus being in a private bank where, you've got high net worth clients versus being in a wealth management firm versus just being at a commercial bank? Aren't these all the same things? You just put money in an account and then hope it gives you an interest rate?
I think at a macro level, I think that is the case, but maybe we can take that in that order because there's the spectrum of scope of work and the services is what really makes the difference and how an advisor or a banker thinks about their client. So in a brokerage firm, an advisor is predominantly thinking about focusing on an investment and investment return optimization of a client's assets. So they may not be addressing the total net worth of the client. They're basically saying, okay, I'm going to put $5 million with Jake, and Jake is going to find an optimized return for that $5 million, whether that is he's going to buy individual stocks or invest that money in some sort of a managed investment account, etc. Whereas if you move further on that spectrum of a private banking, there your private banker is a little bit more holistic about how he or she advises their client in a total balance sheet. It's not only about the asset side of the balance sheet, but it's also about the asset and the liability side. I may be interested in buying a second or third home, or you're interested in buying a jet, or whatever the case might be, passion assets. Then if you truly move to the other end of the spectrum of the wealth management is not only about this assets and liabilities, but it's also about your trust planning, your estate planning, and how you think about inheritance and how you think about lots of other things around your clients. And then if you look at a commercial bank, it could not only be advising on clients' personal assets, but you're ultimately providing liquidity, providing cash management, and providing services to the small, mid-sized companies that these wealthy clients may ultimately end up owning. But to your point about isn't all the problem or what they're trying to solve for the same, from the topic of the conversation, from a digital transformation, digital experience standpoint, you're absolutely right. Because at the end of the day, there is fragmentation of data across these different, business operating models. And ultimately, that fragmentation is resulting in a poor or a fragmented experience for both the bankers, advisors, as well as for the clients that are ultimately consumers of these services.
I think there's also such a profound difference in the business models, which creates really different technology experiences too. So if I'm a broker, generally what I want is volume. I want turnover. So I might design everything around the push to trade. If I'm a wealth manager and I'm compensated on fees on assets under management, then I might design everything to, be around goals, and all the goals are long dated, and you're sort of push towards putting things into a bucket and not touching them. Or if you're a retention-based planner or advisor, then maybe you're putting the client's interest first and not as concerned about the economics. So I wonder what it actually means to do transformation or innovation or technology implementation in a company of the scale, or formerly of the scale of Credit Suisse or the other banks. Like, how does it actually work? It's not like you've got two guys in a garage and then they deploy an app to iOS, right? Like, can you give us some meat for what that work was like?
Yeah, I think it comes down to, first and foremost, these leaders in these institutions really recognizing the need, for driving some of these initiatives and driving some of these efforts forward, because it cannot be driven by a branch manager or a team lead sitting in New York City and wanting to say, hey, I want to change the experience of my advisors or clients sitting in the New York office, right? So it really needs to come down from the top of the organization, needs the right level of sponsorship and ownership. So I think that's extremely important. The other thing that I have experienced in these initiatives is you're really changing tires on a moving car, if I can use that as an analogy, because the bank is not going to stop running its day-to-day operations, or it's not that you are going to be able to rebuild everything from the scratch, because there is a lot of core back-end systems that are required. That plumbing is going to be always there. I think where we have had success, in these initiatives is, coming up with a little bit of a clean sheet thinking to say, and have a managed scope. For example, if the scope of experience is to simplify the product offering and provide a better experience for the client, and it is for this segment of the clients, let's start to innovate a part of that bank's experience, as opposed to trying to boil the ocean with a very large scope, with a very large spend, with a very large effort, without having the proper scope well defined.
I want to push on that a little bit more because I'm just so curious. If I look at Credit Suisse now, UBS, or even JP Morgan, like these companies have been playing around with digital first distribution for a while. So if I think about, I actually don't know in Credit Suisse what the Wealthtech initiatives were, but the work with SigFig on UBS and then the attempt to buy Wealthfront, and UBS had an American version or maybe a European version of a robo-advisor that they sold to SigFig. It's a whole kind of a mess of trying to get that done. And at JP Morgan, there was, I think, a bunch of neobanks that were launched, a SMB one, then a retail one, and the retail one was shut down. And it's hard to understand from the outside because we know that these companies have gigantic advisor desktop platforms, and those desktop platforms have client onboarding, and they have performance reporting, and they have asset allocation, and all this stuff that is sitting in the much more simple digital experiences. What are in your view, maybe the obstacles, or what were the things done right in regards to some of the things that people see on the outside versus what's happening on the inside?
The successful initiatives, and again, these institutions have, very talented entrepreneurs, if I can call them that are, truly entrepreneurs, but operating from within a large enterprise that wants to drive initiatives like this and then deliver value to the business and deliver value to the client. So I think that these organizations, and they have the deep pockets of the ability to make the investments, and they have the client base, right? So unlike a startup, a fintech company who has a great idea and is able to build a great product quickly, don't have the financial resources or don't have the client base to deploy. So I think, what we have seen work really well in some of these institutions is being able to partner with innovative fintech, company, and being able to bring that in a great partnership and launch it, which is some of the examples that you cited where there has been some great success, both for the business as well as for the clients. In other instances, where we have seen success in these large institutions is really ring fencing resources and teams and have a proper governance where the teams are able to go isolated from the day-to-day responsibilities, isolated from the day-to-day, call it complexity or bureaucratic procedures of the organization, but really ring-fenced, teams that can go and try to solve problems in an innovative way. Where I think the most important thing where we have seen success is if the scope of what needs to be resolved or worked on is tightly defined and the teams are set up in a way that they are not distracted from the day-to-day responsibilities. That is where I think, we've seen a ton of initiatives and ton of success, both not only for the businesses, but also for clients. On the other hand, as some of the examples that you've used, these institutions do these work. And the key lessons that I have learned in our experiences for our ability to fail fast and not prolongate in an effort or an initiative for way too long.
Do you have an example of maybe some of your favorite initiatives, either as, this is the most successful thing that we did at JPM or at Credit Suisse, or, this was the fastest fail from which we learned the most? Is there any example you could point to that comes to mind?
Yeah, maybe, this could be one of the connections to Masttro and myself, where I am today. When I was at Credit Suisse Private Bank, I had the opportunity to partner with Masttro platform and offer that to some of our ultra high net worth clients and also create a solution internally for the private banking Americas business by bringing so that is a good, experience that, from my personal perspective, that I would say how you can leverage a small company with an innovative solution, bring that into a large financial institution and be able to do something quickly. So I think there are tons of examples like that. This is just one of my experience and that's relevant for this conversation tied to Masttro. But, we've seen a ton of example, JP Morgan and On Deck, they've done a great job. UBS did that with SigFig, and I think they're still working on that. So I think there is the fintech partnerships with large financial institutions is really a great way to take the best of two worlds and create a great fusion out of it, as long as it's done with a defined scope, with the right partnership and the right governance model.
With that, let's transition to Masttro. Tell us what it is, what it does, and where you are. How long have you been building the company? Have you capitalized it? Do you have clients? What are all the aspects of it?
Good transition. So I've been with Masttro now for 3 years. Then joined the firm 3 years ago. The company has been around for about 10 years now, founded by two entrepreneurs who really sat in the seat of serving multi-generational families with complex global wealth. They decided that there is a lot of inefficiencies in how complex ultra high net worth clients are served. And so they decided to do this purpose-built platform for really serving the ultra high net worth clients with complex balance sheet. The company today is truly positioned as the next frontier in the evolution of how we serve the wealth ecosystem. What we're seeing is that there is a massive amount of intergenerational wealth transfer that's happening from one generation to the other. As we just talked about, large financial institutions and mid financial institutions don't have the resources, or have the resources but don't have the innovative solutions to solve for this inefficiency. I think we see a massive opportunity in the market. What we do today, in a put it in simple words, is if you look at an high net worth, ultra high net worth clients, there is no easy way for the client or the advisors that serve them to really understand what their total net worth is. That wealth and the data behind that wealth is fragmented across different systems, different sources. What Masttro does is it's a technology that provides three things. It's a technology that gathers all that wealth data, structured, unstructured wealth data that is in the form of liquid, illiquid investments that could be custodied or held globally anywhere under any form of structure. So we have a technology that essentially gathers that wealth data together, number one. Number two, provide efficient tools that allows the end user, to manage that wealth data on an ongoing basis, whether that is portfolio management, compliance, billing, CRM, etc. And then number three, provide a simple, intuitive, consumer-grade experience of visualizing that wealth data, for the consumers of that platform. So that's essentially the core of our business: gather, manage, and analyze the fragmented wealth data that exists. So we've been doing it for about 10 years. The company has had significant growth in the last 3 years. As a part of that growth strategy and continue to accelerate that growth strategy, we recently announced an institutional investor partnership with FTV Capital, led by FTV Capital with a minority investment, and Citi Ventures was also part of that round. And we're excited to what's to come. So that's kind of a little bit of where we have come from and where we are today.
Why is it hard to aggregate the data that you describe, and how do you do it?
It's because it's not in one place for somebody to just go and get. If I am a client of JP Morgan Private Bank, I may have 30 or 40% of my net worth as an investment in JP Morgan, but may also have investments at Morgan Stanley. I may have made a private investment in a company that I really like. I may have some real estate property, or I may have some passion assets. So if you really think about whether from a seat of that client, or whether the seat of the private banker sitting inside JP Morgan, neither one of them has an easy access to all of that wealth information to bring it to one place. Because JP Morgan needs to go get the data from Morgan Stanley, or Morgan Stanley needs to go get the data from JP Morgan. And then there is a lot of papers that are available that holding all this other information, and that's the tools or technology is not available, to do that aggregation. And that's essentially where we saw the need, is to be that aggregator that can bring the data from these different sources. And we do it in two ways. One is we have a direct data connection with over 500 financial institutions around the globe to bring that data on a daily basis, normalize that data, reconcile it in an automated way, and push it to our platform. The second part of that is not all data is structured. The data could sit in documents. It could sit in somebody's Excel spreadsheet. So what we have done is we have built an artificial intelligence driven data ingestion module that can take data from documents, ingest that data, and normalize that data into our data structure. So that's essentially the core of why it's not being done and how we do it.
Is the core the ability to connect the wealth management divisions of like the wirehouses and the private banks? Because I'm trying to place it in the context of, we've got Plaid, we have Yodlee at InvestNet, we've got Adapar, all doing kind of large scale data scraping or API connection and getting those positions. I don't know that they spent a lot of time getting high quality wealth management data out of the large banks. The large banks do put up walls and barriers and block fairly successfully people from accessing their data. And then further, the quality of investment data, especially as you do get to the more complex asset classes, the quality of that data is very, very low. So is your sweet spot sort of the large banks? Is that right? And then how do you differentiate relative to some of the other players I mentioned?
Great question. I think some of the names that you mentioned, it's easy to go get balances and holdings and then display it, whether it is screen scraping or whether it is the direct API connection from a checking account, savings accounts, or even getting holdings of a brokerage account, etc. I think when you further go into multi-currency as an example, or when you further go into some of the more complex asset classes as open-ended funds, close-ended funds, and there is lots of different attributes associated with cash flows, whether it is a capital call or a distribution commitment left within a fund, etc. If you take those attributes and take it more further to the right end of that complexity spectrum, of whether it is more complex asset classes or more complex cash flows or transactions, our technology is not screen scraping or getting just holdings and balances. It's really getting the data at the most granular level. It's at the transaction level. It's getting the securities, it's getting the price files, it's getting the holdings, it's getting the transaction, building positions, reconciling it so that you could create that granular bottoms-up performance of the total balance sheet. It is your ability to create journal entries that can go into an accounting system. So I think as you said, the devil is in the details. At the headline level, a lot of people do data aggregation, but then the question is, is it across currencies? Is it across asset classes? Is it what level of granularity, how sustainable or automated that aggregation technology is? And I think that's where we really shine, is where we have focused our efforts on and continue to invest and innovate is dealing with that complexity. I have a Chase.com retail account and I've been a Chase customer for decades. It's easy for me to connect my PNC bank account at Chase so that I can see the balance of all of my savings account in one place. But that level of complexity is very different in scale compared to a $50-100 million balance sheet that has 3 currencies and 10 different custodians, and 30% of that is liquid investment, 70% of that is illiquid investments and other items. So it's a very different portfolio asset allocation dynamics. And where we try to focus our energy and our technology shines is when you're dealing with that complexity of what I described.
So let's say 70% of the balance sheet is private investments and illiquid. There are so many challenges there, and I'm curious how you approach them. So the first challenge is all the subscription documents. There's 150 pages of scanned PDF that is slightly askew and looks like a photocopy. That's your cost basis, let's say. So one question is, how do you go from there to actual numbers inside of a database? Are you using image recognition? Do you have staff that's focused on importing that? Like, what's the process of getting things that are not structured into a structured format. And then the second question I would have is around, if something is a liquid and you're showing net worth, like how do you think about performance? Do you mark things using indices? Like how do you really show that net worth over time?
So to answer the first question, just in terms of how we think about dealing with this unstructured data sources, I think first and foremost for us is the way we designed the platform and the way we're continuing to, innovate the platform is to have the right data structure to be able to capture the right level of attributes. So at the core of it, it's the data architecture to deal with these different types of investments, to deal with these different types of attributes that goes behind these investments. Because a lot of the reporting solutions that are in the market, it's an alternative investment asset class is a line item, right? So, hey, private equity XYZ has valuation of X, has a committed capital of Y, and etc. There is the granularity that goes behind the metrics or the attributes of that is not even contemplated in building that platform. So I think the difference for us is we were born with that, dealing with that complexity, and those attributes are there in the platform. Because forget about where that source data is. If you can get to the source data, and if you don't have a data architecture to support to put that in, then it makes no sense. So that's number one. Number two is that I think the way that our platform is designed and set up is both from the onboarding of a new client and setting up of the new client, we have technology that is built in to deal with that level of inefficient data sources, right? So we work with our clients in bringing that unstructured data using technology into our platform. So yes, we have a document ingestion engine that has character recognition, AI ML based recognition, pattern learning, and etc. So the technology is what we use to drive that efficiency. We're not in the business of providing managed services to our clients, but we have partners that are very familiar and very power users of Masttro platform, and they provide services to our clients using Masttro as the technology enabler in providing those services to their clients. So that's essentially how we think about the first part of your question.
And then in terms of trying to mark to market or to show net worth over time.
Yeah. And that goes a little bit back to what I said before. It's the core of the data architecture and the design of the Masttro platform. Whether it is you have an investment in Apple, Google, JP Morgan stock, or you have a bunch of fixed income funds, or you have an investment in a KKR fund, or you've made a direct investment into a private company. For us, it's the way our data architecture is set up is, we gather the data at the most granular level across these different asset classes. And then we are able to perform, IRR calculations, XIRR calculations, because we have all the data attributes. And then we also provide little over 100 plus benchmarks that our clients can, use to set up, however they wanted to slice and dice the data. I'm interested in looking at, my the investments that I'm making through the foundation, or the investment that I'm making through the trust, or the investment that I'm making through my personal account. How are those investments performing against a certain benchmark, or how is my total portfolio, total balance sheet performing against a certain benchmark? That's at the beginning of what I said, gather, analyze, and manage. The analyze part of the platform, once you have this granular data behind this massively powerful but yet simple and intuitive platform, you can slice and dice the data any way you want through our front-end user interface, whether that is on a phone or whether that's on a desktop.
Gotcha. So you're including performance calculation based on whatever underlying data you ingest, and then your engine's able to do that attribution.
That's the biggest power of the Masttro platform is our ability to bring the data at that granular level and being able to perform the various analytics, including performance calculations across the total portfolio.
Gotcha. Okay. What do the clients look like? Who are the clients? I mean, it sounds like there is a end user experience on mobile and web. Is your ideal client like a private bank or a large institution that has kind of an ultra high net worth division? Do you sell them everything through APIs or is it private label? And then in terms of the end clients, you've mentioned 50 million, 100 million. Is that kind of the line above which you feel like the platform shines? Can you talk about sort of the model, both in terms of the immediate client, how you work with them, and then the end client?
We think about our clients in two broad segments for simplicity purposes of this conversation. One is what I would consider as a direct client, and these are either an ultra high net worth client who directly wants to get a Masttro platform or subscribe to the Masttro platform, or through a single family office of theirs, right? And single family offices are a little bit like snowflakes. They're all very different. So that's our direct client. So in that segment, I would probably say the asset threshold, we don't charge them by assets, but typically the asset threshold or the complexity is about, call it north of $100 million. If a wealth owner is coming directly to buy the Masttro technology, because it's not only about, it's where it makes most sense for them to do that. The institutional clients come in lots of different flavors. It could be an boutique RIA operating as a multifamily office. They have 10 clients, they have 50 clients, they have 100 clients. Doesn't matter for us. Or it could be a very large private bank, global financial institutions, and they are offering, Masttro like technology with their services to their ultra high net worth clients, and the client threshold could be defined by the bank. It doesn't matter. The technology works for a $5 million client. The technology works for a $5 billion client. So it really doesn't matter. The way we are delivering technology to both of these segments today is software as a service. So they have access to our front end that can be white labeled and configured to their needs. We are exploring and working on, obviously there are open APIs that are available for our clients to consume data from the Masttro platform and ingest that data into their own front end. But we are on the early stages of exploring that engagement model. But current engagement model is white labeled software as a service delivery to both direct clients as well as the institutional clients.
Okay, question on the asset classes that this population invests in more broadly. In our coverage of the investment management industry, there's sort of this consensus or this outlook that the core portfolio, equities and fixed income, isn't particularly interesting, or maybe fixed income is interesting right now, but not fundamentally, and that it is alternatives and long tail risk assets, whether it's crypto assets or art assets or real estate, that are becoming more and more accessible. And especially there's been so much effort in taking the alternatives asset class and making data more available, trying to create secondary liquidity, trying to create market venues, creating reporting and all of this. So the question for you is, based on your interactions with this audience, what kind of trends are you seeing in, whether it's asset allocation or alternatives more generally? Like, what seems to be rising in terms of behaviors and investment preferences?
Yeah, I would say in our segment of the clients that we serve, yes, liquid investments is obviously part of everybody's portfolio, but where we're seeing more and more interest, what our clients are doing is, alternatives, but alternatives is this wide range of things, right? It's a very broad term. There is alternative funds, there is feeder funds, but then there are also some more interesting direct investments that we see our clients do, whether that is them investing directly in a portfolio of companies. They're almost operating like, some of the family offices operate like a mini, growth equity firm or a venture capital firm or a private equity firm for that matter. So I think the direct investments are something that we're seeing more and more in our client base. We also see a lot of real estate, both in terms of investments in real estate type of whether it is funds or whether it is true real estate properties, right? Commercial, residential, etc. I would broadly categorize this business interest as an asset class, because business interest could be anywhere from operating companies to the operating companies that they own and manage, etc., but also operating direct investments that they make in these things. So as you get to call it $100 million plus, we would see a fair bit of, call it, if I were to just throw a percentage out there, anywhere between 30 to 40% of their investments would fall in these category of business interest, direct investments, real estates, and then there is about, call it, another 30% or so in other alternative investment sources, and then the remaining in a more of a liquid investment portfolio. But that's where our platform delivers more value, and that's why we're seeing more of that with either our institutional clients or our direct clients. That's where there is a lot of inefficiency as well in delivering experience to the clients and advisors, and that's why we see those types of investments as in asset types in the clients we deal with.
Is the proliferation of technology around these asset classes going to make investing in them more accessible? Again, one of the narratives and the stories that continues to repeat is how you can invest in Hamilton Lane through tokens on Securitize at a $10,000 minimum, things of that nature. Given that there's so much more data and so much more digitization of previously inaccessible asset classes, do you feel that more and more people will have access to them, or is that kind of just a story and kind of the same market structure will persist?
No, I think we have already seen the trend to that, right? The evolution and innovation in technology has democratized the investments of these more complex asset classes. If you think of alternative investments, a private equity or a hedge fund or a venture capital, you think of whatever, right? I mean, if you think about 20 years ago, an RIA serving a $25,000, $50,000, $100,000 clientele don't have access to those types of investment classes or to those asset classes. But today, through innovation and through emergence of alternative investment marketplaces and through what people like iCapital or Case and some of these organizations are doing, is bringing that type of asset classes and make that possible for people to provide that. My dear friend in Halo Investing is doing exactly that with structured products and annuities. So I do think that there are these technology platforms that are providing scale, but also providing access to these types of more complex asset classes to the to the more, call it, the affluent or the mass affluent. And I can see the same thing continuing to where in the early stages of that happening in the digital assets, in the crypto world, or in the private investments, and what family offices are doing, making these private investments themselves, is through these things. And we see that evolution, that similar evolution that we have seen that has happened in the alternatives asset classes, should and will happen through technology in some of the even more complex asset classes, and giving access to both the affluent and the end of the client segment, but also the high net worth and the ultra high net worth end of the client segments. What we are seeing is that over 70% of especially the next generational resources are getting engaged in making these investment decisions. They are 70% of that population, the next generational investors, if you want to call them that broadly, are invested in some of these more newer and emerging asset classes, such as cryptocurrencies or digital assets or luxury assets, direct business interest, etc., which I think we're at the beginning of that evolution of where we saw alternative investments 10 or 15 years ago.
Fascinating stuff. I have one more question on this point around intergenerational transfer, because I know it gets thrown around a lot as validation for going more digital and having more digitally native tools. What's your thought on whether that's actually happening? Do you see any trends that support the transfer of wealth to people who expect different experiences, or is it really kind of just a story that continues to be told and isn't very real?
No, I think there is definitely data that supports it for sure. Just in terms of the macro data of whatever $84 trillion or whatever is going to be transferred over the next 20 years. But you see it in day to day, right? It's not only, we often say this intergenerational wealth transfer is going to demand change in consumer or customer experience. We see that happening every single day with our clients that are, whether it's older clients or younger clients, it doesn't matter. People are looking for transparency and better control over their total net worth. And they wanted a more simple and an intuitive experience to do that, because they get that pretty much in every other aspect of their life other than two places: health and wealth. So that's why you see there is so much going on in the healthcare tech, which I'm not an expert in. But as a consumer of my health information, it's as fragmented and as bad. And I think we're seeing that every day. So it's not only the intergenerational wealth transfer is driving that demand in this simplified consumer grade experience. It's also the existing, call it, even without the intergenerational wealth transfer, that consumer grade experience demand is there, and it is real, because people want to have better control, better transparency, and informed decision making. They're looking for that stuff, and no longer this, I get my statement, 14 different statements in an envelope or in a PDF document delivered to me once a month or once a quarter, and I have to add all that up using Excel, and then I have to make a decision. That, I think that's what that driving that demand for new experience.
Fascinating stuff. Thank you so much for opening up these ideas. If our audience wants to learn more about you or about Masttro, where should they go?
Our website is a great place to start. It's masttro.com. It's MASTTRO. And the 2T stands for today and tomorrow, or technology transformation.
Fantastic. Padman, thank you so much for joining us today.
Thanks a lot.
Hi, everyone. That's it for this week's episode of the Fintech Blueprint. For more technical deep dives into all things fintech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.